Hi everyone, welcome back to the US CPA classes. Today we are studying business analysis and review, and in this particular video I'll be walking you through in detail about prospective analysis including the use of data, and the specific topic we'll be covering is the capital structure. In that we'll be understanding risk and the category of risk. So let's understand in detail about capital structure, risk and the category of risk in detail.
Hi everyone, good morning and welcome to the BAR class. So we are in chapter 2. So far we have covered this entire section of 2.1, and in 2.2 also, the last class we have covered budgeting, forecasting and projection, and today we'll be starting with capital structure. Right. So so in the capital structure we'll be understanding in detail about four things. One is the risk. First, we'll be understanding more in detail about definition, what is capital structure is all about, what does it include and what does it not include, or what is excluding in it. And then we'll be understanding more in about the risk, which include like the business risk as well as some operational risk. And then we'll be discussing about the leverage, which include like both operating leverage as well as finance leverage. Then hope you remember, like from the college day, we have studied a difficult topic, capital structuring, right? So we'll be discussing in that. In addition to that, in capital structuring, we'll also cover the weighted average cost of capital. So that was like complex topic during our college day when we were used to do that, right? So we'll be covering both of them, right? And then after the financial structure, we'll be discussing. So any idea, any thought you have what is capital structure is all about, or anything you remember from your college day or from your when you have studied any professional education? So what is capital structure is all about? Any idea?
Yeah, capital structure includes the equity and debt of the capital of the company.
Yeah, definitely. No, thanks, Matthew. I think this is really good one to start. So if you remember, when you look at the balance sheet, right, in the balance sheet, we have like major component is like in assets, we have current assets, non-current assets, including property, plant and equipment. And in the liability side, we have liability, current liability, non-current liability. And third major and important topic is equity, right? And same way, there is like statement of equity also. So what all things comes under the equity and what all things is helping you to finance your business will consider as part of your capital. That means the fund which you are receiving for the operation, maintenance and running as well as capital need of the organization is generally considered as a capital item, or you can say financing item, which include your equity. So equity, or you can, if I say, which include your share capital. So share capital may include your equity, like how we say equity, but in US we call it stock generally, like we have discussed earlier this. In addition to that, any preference share are there. If there is any ESOP, if there is any, you can say additional share issue to vendors, compensation to the vendors, or maybe your retain earning, right? And reduced by if there is any buyback, that is your treasury stock if you have, right? In addition to that, you'll get a lot of you'll get some funding from the bank as well as from the financial institution to finance some of your capital need and some of your working capital needs. So such short-term debt, long-term debt is also being covered in the capital structure. So capital structure is basically the mix of owner fund as well as preference shares as well as retained earning as well as debt, which include like loan and debentures, both, right? So the capital structure is a mix of your debt, preference stock and equity, which is used to finance an entity assets and operation. So while developing a capital structure, we need to evaluate a couple of things. So these are the four things which we need to keep in mind. First and foremost important thing is risk, right? Risk include both business risk as well as operation risk. In this, we'll be understanding in detail about interest rate risk, reinvesting risk, liquidity risk, market risk, company risk, as well as credit risk. So all these 6 parameters will be understanding in detail, which is impacting while taking the decision to what category of finance we should be opting in the relevant situation. Second, we'll be understanding in detail about the leverage. So this also, I think, the concept you might have studied during your costing classes in your college days or in your professional education, operating leverage and financial leverage and complete leverage. So we'll be understanding that also in detail. If I go one by one, for example, in risk, so what is your current understanding about business risk? What do you think is the business risk is all about? Any idea? Any thought? Or have you guys heard this term before? Yeah, Surya, Kashish, Matthew, Harini. Have you guys heard about like business risk? Arun, Krishna?
No. Is it like related to any particular type of business that can be incentivized by the government?
Maybe any of your friend, family member, or relative are doing any business by any chance?
Yes.
Yeah, which business they are into?
Grinders.
Grinders. If you can just explain more about it. What type of grinders they
We actually doing both. Like my father is supplying raw materials to the grinders. So my uncle is like making the tabletop grinders, which we use for dosa batters and those things.
Which you use for?
Making dosa batter.
Batter. Got it. So, kind of item relating to home appliances.
Yeah.
Right? Yeah, understood. So, like when you are thinking about like home appliances, so they are in manufacturing or trading?
Manufacturing.
So when you do like manufacturing as a business owner, what all things, like comes in your mind? Maybe the risk that you may lose some business. So one, it can be like the dependency on supplier, right? The raw material from where you are getting, right? Second important thing, the pricing of the raw material, right? If it fluctuates, it will change. Will you be able to pass on that pricing to the customer? Customer is very sensitive, right? On the other side, when you are like sourcing them and then you are manufacturing in it, right? So there may be possibility you might be using labor, right? And the labor may have union or it may go on a strike, right? That can be another risk. Maybe labor asks for more wages, right? There may be like some machinery you may have, so that may go down, right? There may be a repair and maintenance requirement, or there may be change in technology overall that may make your machineries, you can say, obsolete, right? And once you manufacture and you have finished good, there may be a chances. I know, like specifically in this domain, there's no chance, not much cases of spoilage or obsolescence because it's solid one. But there may be a risk of theft. There may be a risk of embezzlement of inventory by the employees or by the third party, right? And when you send those materials to the customer, there may be a risk of in-transit loss. There may be a risk of, you can say, any material which you are transferring from your manufacturing setup to the customer. It may not reach to the customer to whom you have sent, or once the customer has received the inventory, but he's not giving you money back, right? So there may be a risk of bad debt, right? So all these things comes under a bigger umbrella. It's called business risk, right? End to end, as a business, in all overall business scenario, what all risk exists, right? Based on the nature of operation of the business is called business risk. Make sense?
Yes.
Yes.
Second is operating risk. Any idea what is operating risk? Any thought, or have you guys heard what is operating risk?
machine operations, power supply for operations.
Yeah, anyone else? Manish, Harini, Kashish?
Yeah, obsolescence of machines and all connected with that. Like the
What else?
technology changes and all.
Yeah, very true. And like operating risk relating to the operation of the business, right, which is core to the business, which may be like like business risk is the overall umbrella. Within that you may have some financial risk, within that you may have some operational risk, within that you may have some audit risk, right? So operational risks are more relating to the operational activities, right? You rightly pointed out, like the machinery may get obsolete, or maybe inventory may get obsolete, or maybe like any other problem or breakdown in the overall operation. So those all kind of risk is called operational risk, right? So here in the risk category, we'll be understanding six type of risk. First one is interest rate risk. As we are discussing about capital structure, so our focus would be more toward the amount which we are receiving other than sales, right? So other than sales, whatever the amount you are receiving to run and manage the operation of the business are called capital. Or sometime if it is from the government, it can be grant. But in this class, our focus is more on capital related item, which is your equity, preference share, debentures, loans, or you can say the bonds which you have issued, right? So we'll be discussing more in and around these financial items, or you can say capital structure item. So from the capital structure point of view, what all could be the possible business risk or the operation risk? It will be your interest rate risk. That means there may be possibility that the market interest rate will change. How many of you have taken any home loan or auto loan in last couple of years? Any of you, by any chance?
Yes, sir, I have taken.
Right. When you have taken, Ashish?
Sir, in 2020.
2020. So at that point of time, what was the rate of interest? It might be around 8%.
Yes, sir, less than that, in fact.
Yeah, 7.8% or 7.5%
Yes,
something, right? Today it has grown to like 8.7 or 8.8, right?
yes, sir.
So the interest rate change is also impact your cash flows. It
Yes,
also
sir.
impact your cost of capital, right? If the market interest rates change, whether it's being increasing or decreasing, it impact the cost of capital, right?
Yes, sir.
Everyone agree? Second is reinvestment risk. That means, for example, if you have taken the loan and now you wanted to reinvest that into some other activities. For example, if you are an investment company, you may have taken a borrowing that may be from bank at the rate of 6%, 7%, 8%, and you are investing that money into the equity, mutual funds, or maybe you can say startups, or maybe other kind of other category of investment, where you see that money can generate more and more interest, right? That is called a reinvestment risk. That means the amount which you have taken on loan, whether you are investing at appropriate place, that it will be generating more revenue than the interest cost, right? So that is always be subject to risk. It may be possible those equity or those startup or those other investment may generate a better returns or may not generate a better return, right? Second example in the reinvestment risk is, for example, you have issued you can say the debentures. You have issued the debentures of, let's say, 6% debenture for 5 years, right? But the market rate has increased to 8%. So you have already issued the debenture and you have already received the money. So now, like you cannot buy back that before the completion of tenure, right? That is also a reinvestment risk. Another thing could be, for example, you have taken a fixed deposit, right? You have taken a fixed deposit, let's assume at 5% rate of interest, and that is for, let's assume, 3 years. And after 3 years, if you want to reinvest that money, so now bank interest rate has gone down to 3.5%, right? No bank is providing you 5% interest on fixed deposit, which you are generating earlier. So it's a reinvestment risk that where you should be investing that money, right? All such category of risk comes under the reinvestment risk. Make sense?
Yes, sir.
Yes.
Third is liquidity risk, right? So there may be possibility you are short of cash in hand, right? There may be possibility that you have, for example, if you see in the real estate, many of the developer or many of the real estate people, they purchase right, left, and center everywhere, the buildings, the lands, and everything, and they are always be running short of cash, right? If you meet with any real estate person or any builders, so I have seen, like in my experience, like most of them, they keep all their money in cash, and that cash is being used to acquire the other piece of land or other piece of building, right? But if you say in their bank account, generally they have very limited liquidity, right? So the liquidity may result into the loss of opportunities. So as a business, we need to understand how liquidity is also being important considering the nature of my business. Make sense? Yes, no?
Yes, sir. Yes, sir.
Yes, sir.
The next one is the market risk, which we'll be understanding. So market risk is, like on account of change in market positioning. So that may be, for example, if you remember, like back in 2016, when we have this demonetization in India, right? At that point of time, real estate has got a big correction, right? So people who are not aware of that real estate may go down 10%, 15%, 20%, and some of them have gone down up to 30% also, right? That is a market risk, which is not in your control. Same way, like the stock market. So if you are into an investment company who do investment in the stocks, so market is subject to their own risk, right? And based on change in the market condition and market scenario, the share price and the stock price of the respective company stocks or respective industry stocks will vary, or maybe any news in the industry, any news from the government side, any news from the international market. For example, these days, crude oil price, like earlier we were purchasing the crude oil from Middle East and America, right? Now we do purchase from the Russia also, right? Same way, if you see this recently, how this Ukraine and Russia war going on, it is also impacting to the many businesses, right? Same way, like recently, this Israel and Philistine war, which have just started, right? That may also impact on account of many technology transfer agreement that Israel do have with many countries in the world, right? As we all know, like Israel is one of the technocrat country, and they provide a lot of technological support to the world, right? So because of this war, it may impact the respective country businesses because of like Philistine and Israel war, right? That is called market risk, for which you do not have any control, right? The next one is like company risk, which is like the risk in the nature of operation, risk in the nature of the business, risk in the activity which you do for your business. For example, if you are in a real estate business, right, you might be in a requirement of, let's say if you are a builder, you might be requirement of brick, sand, steel, iron, so many like inputs which is being required for the construction, and the labor intensive, right? This is a labor intensive industry, specifically the real estate, and you have to deal with many you can say unprofessional people, also uneducated people, right? And on the other hand, if you see like big consulting firms, right? So they are majority dealing with the professionals, right? And they are dealing with generally with most senior most people in the respective industry, right? So that is all called company risk, in which domain you are, in which profession you are, in which business activity you are, in which operations you are. And the next one is the credit risk. So how many have checked your CIBIL score for any reason or other reason? Do you know
Yes,
what
sir.
a CIBIL score is all about?
Yes,
Yes, sir.
borrowing capacity from banks.
Say that again.
Our borrowing capacity from bank is determined by CIBIL score.
Yeah. So same way, like when you are into the business, you are giving credit sales to many people, right? So in US, like credit assessment is very important if you are giving the credit sales. And same way how we have CIBIL in India, their credit score is also being available on the portals, and you can easily assess to whom you are providing the credit sale, what is their credit score is all about, right? If whether it's individual, whether it's sole proprietorship, partnership, LLP, LLC, C corporation or S corporation, whatever the formation of the customer, if their credit score is not good, then company will generally not provide credit sales to them. On the other hand, on the borrowing also, for example, if you are a company or you are an individual or you are a partnership firm, right, you may also require funds from the bank for the running of your organization, right? So if your credit score is not good, then you may not get the credit, you may not get the loan, or if you get the loan, it may be at higher interest rate, right? So the credit score is very important. So we'll be understanding. So as of now, a high level, I'm just giving you overview about capital structure, what all things you can expect. So in today's class and probably tomorrow class also, we'll be covering only the capital structure. It has a lot to cover, and we'll do some practice question also, and we do some illustration also together, right? But as of now, I'm just giving you bird view, what all things you can expect in the capital structure topic, which we'll be covering today and tomorrow, right? So we understood about the capital structure, the definition of capital structure, and the risk. Now jumping on to the leverage, right? In the leverage, there are operating leverage and finance leverage. Have you heard this term before, leverage, by any chance? Any of you have heard this term before? Leverage.
Yes.
What is that?
It's a thing connected with borrowings and all the risk that
Sorry?
it's a thing connected with the borrowed capital and all.
Okay. Anyone else have any idea about leverage? What is operating leverage? What is financial leverage? Surya, Kashish, Harini, any of you have heard this or not? I'll be more than happy to explain. Don't worry, I'll be explaining it. But I'm just trying to understand whether you guys have heard this term before or not, so that like accordingly, I'll go more deeper.
No comment.
Okay. So leverage is, like it has nothing much to do with the risk, right? It is more about how company is availing their returns for the respective activity. So, for example, have you guys seen income statement of any company? Have you guys seen any income statement for any company by any chance? or we have gone through few examples also.
Yes, sir.
Hmm?
Yes, sir.
Right? So if you remember, yeah, so if you see this one, let me take this. Let me take this illustration for explanation. So if you remember this income statement we have studied in a couple of classes back. So what it says, you have revenue, you have cost of goods sold, and you have some gross profit, right? And then you have some operating expenses, and then you reach to if I say, if I further explain this, earning before interest and taxes. That may be right to say this. Then let's assume you have some interest expenses. Maybe let's say, and then you have, assume income, which is called PBT, profit before tax. So that will be 250 is your revenue minus your sorry, that will be plus minus 1 second. Okay, your operating expenses $100,000, right? And your EBITDA is 150, which is gross profit minus operating expense. Then you have interest expense, or you can say finance expense or cost, whatever you call it, right? And then you have profit before tax. Right. Here you have two things. One is the sales to contribution margin. Right. And then you have another leverage from contribution margin to your profit before tax. Right. So the difference between this revenue to your earning before interest and tax, this all will be considered as operating leverage. I'll explain you, just stay with me. And from here to here is called financial leverage. Right? That means from change of sales to earning before interest and tax. From revenue to earning before interest and tax is called operating leverage, and from earning before interest and tax to profit before tax is called financial leverage. That means from sales to earning before interest tax, whatever the expenditure you have, that is reducing your profit margin, right? So what all operation relating expense are impacting is called operating leverage. Whatever the finance related cost is impacting your profit is called finance leverage in a very layman language, right? We'll be understanding in detail with a lot of examples as well as the mathematical calculation plus the formula of that. But high level, the thing which is impacting, which is changing your profit because of sales minus all the operation related expenses is called operating leverage, right? And the things which is resulting into change in profit on account of financial cost is called financial leverage. Make sense? So far so good. Just for our understanding, we'll be doing in detail, but high level, is it comfortable to everyone?
Yes, sir.
We'll come back to this example with some more illustration, as well as we'll do some formula and practice question also. But as of now, just to understand what is operating leverage, the things which is impacting for the earning before interest and tax to the revenue is called operating leverage, and the things which are impacting from earning before interest and tax to the profit before tax majorly on account of financial cost is called financial leverage, right? We'll be coming back to it for more detail, but as of now we are just doing high level understanding. Right now, third thing is capital structure. So like we were discussing earlier, capital structure is a mix of your equity, your preference share, and your debenture, your debt, and your loans and everything, right? So in this, another concept is weighted average cost of capital. Have you guys heard this term before? Weighted average cost of capital? By any chance, any one of you heard this? Weighted average cost of capital?
Yes, but I forgot what it is.
Yeah, Manish, Krishan, Matthew, have you?
Yeah, we heard about that.
Any idea what is weighted average cost of capital?
Would be the cost of capital and by the shareholders.
Yeah, no, it's not for shareholder, it's for the company. Company need to understand what is the ideal cost of capital. So it should not be like very high cost of capital. If the cost of capital is very high, then they will be incurring a lot of financial cost, which is resulting into or impacting into a reduction in their profits, right? If they have very low cost of capital, that means they are not doing appropriate leveraging, right? So company need to balance it out on their weighted average cost of capital so that it should be in line with the industry norms and it should be in line with the expectation of the management as well as shareholder. It has nothing to do with the revenue or any profit or any dividend which like shareholder will be getting, but it is more about the balancing tool for the overall financial performance of the organization. So if you see like the capital structure, why the company and organization need to manage and maintain appropriate capital structure, there are many reasons to it. One is for the financial risk, second is for their credit score, third is for their operational efficiency, fourth is to managing the cost of capital. That is also very, very important. If your cost of capital is too high, for example, if you have taken so much loan and the interest rate is 15%, 16%, 18%. So how do you grow your business if 15% or 16% of the money which you are generating, you're giving it to the bank, right? So there should be a balancing between taking the loan and the equity involvement, right? That balancing, how do you identify when you calculate the weighted average cost of capital? So that's a key concept. Why do we need to calculate weighted average cost of capital? If you do not calculate weighted average cost of capital, you won't be aware of what is actually the cost of capital you are incurring. It may be possible, and most of the time in Indian organization, I have experienced we are very conservative, right? Whereas like in the US market, European market, or I would say in the Western world, they are being more, you can say, more leverage and try to make it more and more efficient cost capital structure, right? But in India, I have seen, like I have audited company like Goodyear back in 2008 to 2012. I have audited almost 4 year this company, and I have seen they have huge 100 crore of cash sitting in their balance sheet, right? If you go to their, like the Goodyear website, there is a section called investor section, and you can download the balance sheet, because for all the listed company, as you know, it's been mandatory for them to have a balance sheet on their website, right? So you can download their financial statement. You will see like 100 crore of cash is just sitting in their fixed deposit. Same way, I have audited like this company called GlaxoSmithKline. That's one of the like leading pharmaceutical company. And if you go and download their financial statement, they are also being available on their website, because these are public company. It's being available in the public domain. You'll see 100 crore of cash is just sitting in their balance sheet and doing nothing, right? Do we actually need to do such things to make our operation more effective? The answer is no. To be very honest with you, if you ask my advice, I would say definitely no, right? Sitting the cash into the just bank account is doing nothing. It is reducing as per the inflation. Because on the fixed deposit, if you have, you might be earning 3%, 4%, at the max 5%. But the inflation rate in India is 8 to 10%. Same way in US also, the fixed deposit, that is called saving account, the interest rate may be 2% to 3% or 3.5%. Whereas inflation these days is growing like 8 to 9%. Right? If you're putting your money into the fixed deposit, that means you are reducing the value of your money. So if you are into the business, you should know how to manage your cash better, right? And to manage your cash better, what is important? To understand the capital structure and understand the weighted average cost of capital. Because once you understand your weighted average cost of capital, then you can better leverage your funds, right? In this, we'll be understanding short-term debt, right? Any idea what is short-term debt? I'm sure each one of you at least literate about this. What is short-term debt?
That have taken for the short purpose of time.
Within a period of your debt to be paid.
Within a period of
1 year.
1 year.
One
yeah,
year.
yeah, less than 12 months or operating cycle of the business. What is long-term debt? Which is not a short-term debt, right? Which we have taken for more than 12 months, right? Or the operating cycle. Third is preferred stock. What is preferred stock? Do you remember
The
from 11th class?
stockholders which have the preferential rights.
Yeah. So in the preference share, there are also again two categories. One is where dividend is cumulative, and second, where dividend is not cumulative, right? Common stock is equity, right? In US, we call it common stock or stock, but in India, we use term equity, right? Retained earning, we all know, profit after tax from income statement will transfer to retained earning, and retained earning is the accumulation of all years profit after tax, right? Yes, no?
Yes, sir.
So we'll be understanding what is the cost of short-term debt, what is the cost of long-term debt, what is the cost of preferred stock, what is the cost of common stock, and what is the cost of retained earning. And club together everything will result into your cost of capital, right? And once you give the weightage based on the percentage or proportionate, then it will result into weighted average cost of capital. Make sense? The next topic we'll be understanding is the financial structure, right? Financial structure is very simple. Your capital structure plus any non-interest bearing liability like account receivable or accrued expenses, or you can say, I would say prepaid expenses. Sorry, my bad. right? So those are like non-interest bearing. Account receivable, you have to receive the money, right? But there would not be any interest. There would not be any financial benefit, right? That is coming from your sales and operation. Make sense? So this is like high level overview about the capital structure topic, which we are going to study today and tomorrow. Right now, let's jump into the very first topic, which is risk. Right, in the risk we have studied, we have discussed about interest rate risk, reinvestment risk, liquidity risk, market risk, company risk, and credit risk. Right, so let's jump into the topic called risk. So in the risk, again we'll be discussing both business risk and operational risk. And risk increase due to any of the following circumstances. So we need to understand when the risk increase or when the risk decrease, and what are the factors which may impact to the risk of your business. The first one is the more volatility the demand for the organization product and service, the greater the risk. For example, like Bitcoin, right? If you remember, when Bitcoin has came into the country, there was huge demand to it, right? And slowly and gradually it has gone down, maybe on account of certain legal suits, right? But then after it has again pick up the recovery and started again, right? So that is called like high volatile item. Same way like technology industry also, right? If you remember earlier days, C, C++, Java were the main source of language, SQLs, right? But nowadays, if you see like Python, Django, JRD, right? These kind of high-end technologies, coding is being more preferred, right? Same way, like the technology is being ever evolving field. So today, like anyone and everyone is almost talk when they talk about technology, they talk about artificial intelligence, right? So there may be something after a year or so, like something comes like ChatGPT as a complete disruption to the market. If you see, like earlier days when people used to do mathematical calculation, then the era came of the calculator, right? So like everyone has started doing the calculation through the calculator, and it has started giving the accurate result, which is like 100% accurate, right? Then after an era came of the computers, like then spreadsheet, Excel sheet. I'm sure all of you might be working on it, right? So in that Excel sheet, we have started doing the calculation. Then another era came for the advanced Excel. We start using a lot of good formulas in Excel, right? And then after now, the era has came for the artificial intelligence, where you are not required to put all the details. There are so many robotic process solutions are available in the market. You just need to give the instruction and they will plot all the data as per your desired need into the respective spreadsheet, along with the macros, along with the formula, right? Have you heard like ChatGPT for Excel by any chance? Excel ChatGPT or ChatGPT for Excel. Have you guys heard of this tool?
No.
So maybe
ChatGPT.
explore that. I would say explore that. It's an awesome tool, right? It will give you a lot of, it will save a lot of your time and energy in making the spreadsheet along with the data analytics, right? So I'm sure some of you might have heard of data analytics, Power BI, Tableau. Have you guys heard of such tools?
Yes, sir.
Right? So, like 3 year, 5 year from now ago, so Tableau, Power BI, data analytics were considered to be the big game changer tool. But if you research on this Excel ChatGPT, it will be killing it, right? If you remember, like earlier days, content was king. You all might have heard, right? But now with the ChatGPT, everyone and anyone can write any kind of content, right? So the technology creates a lot of disruption and volatility in the market. So we need to understand in which industry we are, right? And how volatile that industry is all about. Same way life science or healthcare industry, right? That's also, like kind of ever evolving, right? Earlier, there was no curation for the cancer, but nowadays we have cancer curation center. If you remember, like before the independence, there was no cure of TB, but after the independence, I think in 1960s, so we got the cure of the TB also. I know like each one of you might have polio drop, right? Earlier, the polio was a big disease, right? So these all things are considered, like how volatile that market is and how this disruption can be possible in the respective market that may impact to your business. So if something is impacting like this to your business, so you need to consider that as your business risk, right? Second is higher and fixed cost. So how much is the capital intensive your industry is? Are you in real estate industry? So that may require huge amount of capital investment. Are you into automobile industry? Right, that also required huge amount of capital investment. Are you into the healthcare industry? Right, hospital industry, hotel chains, right? Those are like capital intensive. Or you are a tech company that is more of labor intensive, may not be having so much fixed cost. So accordingly, you need to make your business risk assessment, right? Why we are understanding the risk, so that we are in a position, we get into the position where we can assess the risk better and plan the controls to those assessed risks, right? So higher the fixed cost of the firm at operating level, the greater the risk that the break-even point will not reach. So what is break-even point? Have you guys heard this term? Or have we discussed this in earlier classes? Break-even point?
Zero profit or zero loss.
Yeah, zero profit, zero loss situation, right? So if the fixed investment is high, that means your fixed cost is high, right? So you're reaching out to the break even for the fixed cost will take longer time, right? So that is again a risk of the capital investment. Next is the more variable in the sales price for the firm product, the greater the risk. For example, textile industry, food and beverages industry, fruits and vegetable industry. What is variable? I know some of you might have studied ASC 606, revenue recognition, right? There we have discussed about variable consideration and constant to variable consideration. Any of you remember that by any chance?
Yes, sir.
So what was the variable consideration? So variable consideration is, which is not a fixed consideration. That may be the sales incentive, right? That may be, you can say, trade discount. That may be cash discount. That may be volume discount, right? That may result into the impact on revenue, right? On the other hand, we have discussed about constraint to variable consideration, which results into reduction in the price, right? That may be on account of giving the loyalty points, giving the reward points, providing the discount to the customer, right? So if you have a lot of variable component in your sales, that means you have various sales scheme, you have various sales incentive scheme, you have various, you can say, constraint, right? So the volatility, that how much price, how much sales, how much amount you are actually going to recover for the particular product and service which you are providing to your end customer will be different, right? So that is also another risk. Next is, the more volatile the cost of input, the greater the risk. For example, like if you are in any industry which is relating to the petroleum, right? For example, if you are in manufacturing of polyethylene, polypropylene, or maybe any other petroleum jelly or any other petroleum product, and your company is being dependent on the petroleum as their input, right? So if you see, petroleum is generally purchased in the international price, right? This is a petroleum price index which fluctuate every second, same like stock index, right? So you do not know at what amount you might be purchasing. For example, like 2 years back, India was purchasing the petrol at $100 to $120 per barrel. But from last 1 year, we are purchasing in a range of $35 to $40 per barrel, right? Nothing has changed from the India perspective, but it's again changing the international pricing based on the fluctuation in the international market, right? Make sense?
Yes, sir.
Same way, like if you are being dependent on other raw material, for example, like steel, right? If you are an automobile company, you may require a lot of steel. If you are a tire manufacturing company, you may require a lot of rubber, right? So their pricing are also being measured in the respective price index, and those price index keep on changing, right? So that may impact your cost of input, right? Fifth point is the less firm ability to pass the price increase for material, the greater the risk. So there are certain industry, like specifically if I say FMGC industry, if there is change in cost, right, it is very difficult to pass on that cost by increasing the sales price to the customer, because customer is very sensitive, right? If you remember, like, have you heard about this _G biscuit by any chance?
Yes, sir.
Right? Any of you like it? So that's just kidding. If you remember, like since the day you might have born, G price is same, 5 rupees. Yes or no?
Yes, sir.
Right? So when you were 10-year-old, then also you might be purchasing G for 5 rupees. Today also you are purchasing it for 5 rupees, right? Why so? Any idea why so?
Because sir, they have already made the perception of the cost. Like at this cost only, you would be able to get this item.
Any other thought? Anyone else would like to share why the Parle-G always cost 5 rupees?
They decrease the quantity of the biscuit.
Yeah, that's one thing. But why the price is always 5 rupees?
So customer has a fixed mindset that Parle will only cost rupees 5. If they
Yeah.
change it, then no one will get.
Yeah, very true though. Like Indian market is very price sensitive market. It's not like they always keep it 5 rupees. They have started with 25 paisa and they have reached to 5 rupees. But after that, they have tried to make it 10 rupees, but they have seen a significant drop in their sales. And Parle-G is their brand which they have established in last 50, 60 years, right? And which they do not want to get dropped. So strategically, what they have done, considering the price sensitive market, they have kept the pricing same, but they have reduced the quantity and they have reduced the packaging. Why so? Because they know the Parle-G biscuit, 5 rupees biscuit, generally lower class people, or maybe like for the people who look for daily bread and butters, are being the main consumer. But at that point of time, like the people will be consuming Parle-G, but slowly and gradually, as their level of income rise, as their standard of living rise, they may choose to buy more and more product of the 𝐂𝐴𝐺. Because if you see, 𝐂𝐴𝐺 have varieties of products, but they have still kept 𝐂𝐴𝐺 biscuit, small biscuit, always be of same price. It's kind of strategic decision they have taken on account of significant drop which they have observed when they have changed the price from 5 rupees to 10 rupees for the same 𝐂𝐴𝐺 biscuit. So you need to understand whether you can pass on the increase in cost to your customer, or your customer is very sensitive about the costing. Right? That is also very important to understand when you are doing the business risk assessment. Right? The last one is, the less the firm ability to develop new product in a timely, cost-effective manner, the greater the risk. So if you remember, like the mobile company Nokia, right? If you remember your school days or your college days, everyone might have some or the other mobile of Nokia, right?
Yes, sir.
But where they have gone now, they have significantly reduced their market share. You know, there was a days from 2005 to almost 2010 or 2000, you can say 12, the Nokia was having almost 60 to 65% market share in the mobile market, right? But why they do not exist now? The reason is they have not worked on the new product development, which is being the need of the market. Same way, if you remember in your home, you may have some old days camera of Kodak, right? You may have some old days camera which is having like film, like Kodak film, Fuji film, right? You may have some memories of with that camera also. But where they have gone now? In each mobile is the camera, right? They have not evolved and they have not collaborated with these mobile company. Otherwise, they could have still exist, right? Same way in the electronic industry, there are so many product and dynamic changing. If you're not evolving with the market trend, then it's a business risk, right? So when you do the business risk assessment, you need to keep all these points in mind, and accordingly, you need to identify the risk so that you can consider the controls around those risks, and you can consider the step and strategies required to cope up with those risks. Right? Make sense?
Yes.
So this is about capital structure overview and the risk. Now we have 6 category of risk. Maybe shall we take a break or shall we finish this category of risk? How are you guys feeling?
तो कर लेते हैं.
Okay, let's finish this category of risk topic and then we'll take a break. So in the category of risk, right, if you remember, we discussed about interest rate risk, reinvestment risk, liquidity risk, market risk, company risk, and credit risk. Now we'll be understanding one by one in detail. The first one is interest rate risk, right? So interest rate risk is basically the change. There may be possibility of change in interest rate, right? If you have money in hand, you have given into the bank for the deposit, right? So today you might be earning better interest rate, but tomorrow it may be possible that interest rate on the deposit may go down, right? On the other hand, you may have borrowing. Today interest rate is less, but tomorrow it is possible that bank may increase the interest rate. So that is called interest rate risk. That means on account of change in rate of interest, the financials, cash inflows and cash outflow of the organization may impact, right? So interest rate risk on the value of fixed interest bearing instrument such as bond when interest rate are changing. So the price of long-term interest bearing instrument is more sensitive to change in the interest rate than the price of short-term instrument. So this is very important. like the short-term, you can say borrowings, which is less than 12 months, generally your working capital loans, right? So for that, like every 6 months, every 1 year, every quarter, there would be changing over or rolling over. And you'll be more up to date according to the market interest rate. For example, you have taken a short-term loan for 6 months in January 2022, right? That is completing on 30th June 2022, and you'll be repaying it. After that, you may have more needs for the working capital. Then again, you have applied for the loan, right? So the first loan which you have applied from on 1st January 2022, that was bearing interest rate, let's assume 7%, right? And the market dynamic has changed, and the banking, like maybe like how in India we have this Reserve Bank of India, same way in US also the Reserve Bank of United States of America, that has reduced the repo rate, right? And that repo rate reduction has been cascaded to the customer of the bank. So the bank has also reduced the interest rate on short-term borrowing. That means when it comes to short-term borrowing, it is more according to the adjusted to the market changes, right? On the other hand, if you have issued a debenture, 10-year debenture at 8% interest rate, so it is possible that today's interest rate is 8%. But in future, if it increases to 10%, you cannot go back and ask your lenders to take money back, right? So what does it mean? The price of long-term interest-bearing instrument is more sensitive to change in interest rather than the price of short-term instrument. Make sense? Why? Because short-term loans and short-term borrowings are generally adjusted to the market, current market scenario, whereas long-term interest borrowing are generally fixed, right? And they are not adjusted to the change in market condition and market scenario. Make sense?
Yes, sir.
If the market interest rate increase, then bond price goes down. And if the market interest rate decline, then bond price go up, right? Generally, longer the maturity period, greater the interest rate risk is over, right? Second is the reinvestment risk. Reinvestment risk, like you remember earlier we have discussed. So today you have made certain investment and you are earning either interest or dividend. Tomorrow, when you are reinvesting that money after getting the funds back, will you be able to get the same return, or will you be getting more return or less return? That is called reinvestment risk, right? So reinvestment risk arises when the investment rollover. If the rate have declined, then interest earned will decline. If the rate increase, then interest earned will increase. For example, there is a treasury bond of $100,000 at the rate of 6% for 5 years, and the interest reinvested at the rate of 4%. It is a risk when investor is not able to find the similar paying investment, right? That means originally you are getting 6% interest, but if you are reinvesting the interest, you'll be getting additional 4%. Why you will accept that? Because you are not getting the better option to reinvestment, right? That is called reinvestment risk. Any doubt?
No, sir, clear.
Next one is liquidity risk. What is liquidity? What all comes in liquid assets? If you remember from your school day, current ratio.
The cash.
Cash and cash equivalent,
Yeah.
right? Which is highly liquid assets, right? In the cash equivalent, there is a marketable security which has original maturity less than 3 months as well. right? So liquidity risk, highly liquid assets like US Treasury bond can be sold on short notice at the market value. However, there are many assets like inventory, account receivable that changes and infrequently often do not have ready market, right? If you remember current assets ratio, what is the formula of current assets ratio? Do you remember
Current
that?
asset by current liability.
So what all things comes under the current assets?
The cash and cash equivalents and other current assets.
Sorry?
The cash and cash equivalents and other current assets like current liabilities that needs to be paid within 1 year.
No. I'm saying current assets.
Sorry.
What all things comes
Current
under
assets. The bank, the bank deposits, and
what else? Kashish, Arun, Harini. What is current assets? What all things comes under the current assets? Come on, guys, you are doing CPA. Don't tell me you don't know current assets. It will be shock to me. Manish, Krishan, Harini, are you guys here?
Yes, sir.
What is current assets, Kashish?
Sir, liquid assets होते हैं basically short term assets होते हैं.
No, what I'm saying, what is current assets? What all things comes under the current assets? You have seen financial statement. I have shown you many
Sir,
times.
account receivable
And
prepaid expenses.
stock inventory वगैरह. Stock
Hmm.
inventory.
Inventory.
Yes.
What else? Have you guys studied like current asset ratio in your school days by any chance? In your college days?
Yes.
Yes, sir.
So what is the current assets you are considering there?
Sir, cash and cash equivalents as well.
Cash, bank,
Oh my God, is it so
short-term
difficult test?
investment,
No, sir.
short-term investment,
Short term. Sir, any any marketable securities as well.
That is your cash, bank, marketable security, which has less than 3 months of maturity value, right? Your inventory, your prepaid expenses, and your account receivable, they all comes under the current assets, right? What is liquid asset?
cash, bank,
And
one more thing come.
Yeah, what is that? One more thing. Oh, boys, come on.
Sir, marketable security.
Marketable security. What does not come in liquid assets? Inventory, prepaid, and account receivable, right? So here we are talking about liquidity risk. That means we are talking about cash, bank, marketable securities, right? We are not talking about inventory. We are not talking about account receivable. We are not talking about prepaid expenses. Make sense?
Yes, sir.
So highly liquid assets like US Treasury bond can be sold on a short notice at a market value, that is marketable security. However, there are many assets like inventory and account receivable, right, that change the hand infrequently, often do not have ready market. For example, if you have inventory today and you wanted to liquidate all the inventory, will you be able to liquidate at sales price? You have to give a heavy discount if you want to liquidate, right? Yes or no? Yes or no? At least respond.
Sir, एक बार repeat करना.
If you have a lot of inventory in your hand will you be able to encash that inventory immediately? Or if you have to encash that immediately, do you need to give heavy discount?
Heavy discount.
Yeah, heavy
सर
discount.
heavy discount देना पड़ेगा.
Right? If you have inventory, that is your current asset, but that is not your liquid asset, which is being available immediately in cash. Right? It will take some time to liquidate. Right? And if you want to liquidate just now, then you have to give a heavy discount. Right?
Yes.
Right? Same way, you have account receivable that you may have huge balance, but account receivable will be actually received upon completion of the credit period, right? And there may be possibility of few bad debts, but it is not immediate cash, right? Yes or no? So hence,
Yes.
those things are not covered under liquid item, right? Therefore, the price reduction are often associated, right? So liquidity risk is the risk that an asset cannot be sold for the market value on a short notice, right? That risk is called liquidity risk. That means inventory you cannot sell immediately at a sales price. Account receivable you may not be able to collect immediately in full. If you have to collect, then you'll be giving a discount, or you might be factoring it to the bank, right? So there would be some charges to factoring, or there would be some expense on account of discount which you are providing. Make sense?
Yes.
Yes, sir.
Fourth is market risk. So market risk is risk associated with the security that cannot be eliminated by diversification. This include items such as recession, inflation, change in interest rate that affect the firm. And this is also known as systematic risk or inherent risk. Market risk is the risk which exists in the respective market. Right? For example, if you are into the business of real estate, right? So there is a risk that labor may not come on time, material may not come on time, right? That exists into the nature of operation. You cannot change it. If you are in petroleum products, there is a risk of change in the petroleum price. That is inherent risk. That is in the nature or operation of the business. It has nothing to do with you, right? Those type of risks are called market risk. Make sense?
Yes.
Yeah.
Next one is company risk. Is a risk that's specifically associated with your organization, with your particular firm, with your particular company. That may be on account of product mix, that may be on account of competition, that may be on account of lawsuit, that may be on account of patent, right? And within a portfolio, company risk can be eliminated by proper diversification. So, for example, like Arun said, like his family is into the business, right? So, in that particular business, what are the risks specific to their business of their organization? The competition, right? At what price you might be selling, and at what price your competitors are providing, right? Second is the raw material which you are purchasing, right? That is specific to your organization, right? Same way your customer as well as your supplier, right? That may be like sole supplier, that may be sole customer. That kind of risk would be specific to the organization, and it vary from organization to organization, industry to industry, and business to business. Make sense? What is called company risk, which is specifically relating to your organization. Make sense?
सर कंपनी रिस्क में सर एक्सटर्नल फैक्टर्स भी इंक्लूड होते हैं क्या?
No, it is more of internal factors.
Okay, okay.
Right? Next is credit risk, which we have discussed earlier. Credit risk is the risk that receivable will not collect in full on a timely basis. Right? It is not. It is also known as default risk, right?